Hey, it's Tom here and welcome back to the channel. It is monthly Q&A time here again on the YouTube channel, and I put up a community post just yesterday collecting some of your questions for this video. So thank you to everyone who did ask a question. We've got lots coming through, and if you want to have your question included in next month's Q&A video, just keep an eye out for any time I put up a new community post. You should be able to turn notifications on for those posts. That's where I always collect Q&A questions for these monthly videos. So I'm basically just going to go through some of the questions from people who got in there really early and asked a question almost immediately. I'll go through some of the most thumbs up questions as well, and then I'll go through a few kind of in between. So I do hope you enjoyed the video, but before we get into it today, we do have a sponsor for this one, and today's video is sponsored by Hatch. Hatch is the platform that I personally use for all of my US investing for me as a Kiwi based here in New Zealand. And Hatch is asking you to think about what your big and small tomorrow goals look like. For me, the goal has always been financial freedom, putting a little bit away today with the aim being that I can do the things that I want to do tomorrow. That's why I invest with Hatch to help make my plans a reality. If you want to get started investing with Hatch, check out the first link in the description where you can get a free 20 New Zealand dollar top up when you make your first deposit of 100 New Zealand dollars or more before the 31st of December 2022. Okay, so first question here is from Fuhat. Hopefully I'm not butchering that name. Thoughts on BLK, which I believe to be Blackrock. I made 22%. Okay, so I don't know that I'm going to have a lot really to offer on Blackrock. I think this is one of those companies that is definitely stretching, but probably outside of my circle of competence. It's a very large and very complicated kind of behemoth in the asset management industry. So I don't think I'm going to have a lot to offer on that one, unfortunately, but the long-term track record is definitely phenomenal at Blackrock. So thank you for your question, but unfortunately I don't think I'm going to be particularly helpful on that one. Next one is from Nicholas Thompson. Do you subscribe to the notion that there are value traps? If yes, how do you spot one? Yeah, there's certainly like the traditional value trap. I guess anything, a value trap, at least the way I think about it, is just something that looks cheap and it turns out it's not as cheap as you maybe first thought. So it's usually characterized by things like really low PE ratios, maybe a very high dividend yield, and basically any time that you stumble across something that's trading at 2 or 3 or 4 or 5 times earnings or something, really that PE ratio that's very low basically implies that the rest of the market thinks that earnings are going to decline substantially. Things that are growing earnings, really smoothly over time don't tend to trade at like a PE of 3. So you do definitely have to be very cautious with those things. And really, like I say, anytime you stumble across those types of stocks, your main job really is to figure out, one, are earnings really going to decline? And if you find a situation where maybe they're not going to decline or the decline is going to be very minimal, that could be a very interesting situation. So yes, there are some very basic signs, but at the end of the day, I think it was Guy Spear or Monish Prabrai said something to the effect of there's no such thing really as value traps, but there are such things as bad investments. In other words, if something's trading at a PE of 3 or something, you need to do the work in order to understand whether what earnings are likely to look like in the future. And if you buy into a stock that looks really cheap and the earnings just don't show up, that it's kind of textbook value trap, but really it's a mistake in your analysis of the company. Next question here is from Yugal. Again, hopefully I'm pronouncing that correctly. What happened to your fellow YouTubers like Brad, Frank, CJ? They seem to have stopped making videos and you guys stopped collaborating. Yeah, I don't want to really speak for any of those guys, but Brad and Frank particularly, they're still members of the Punch Card Investing channel, so go and subscribe to that. It's a weekly live stream show that 5 of us do here on YouTube, and Brad and Frank are still regular participants in Punch Card Investing, and I know that Frank especially is very active on Twitter still, if you don't follow him over there. So those guys are definitely, definitely still putting content out there, and I think Brad, again, I don't want to speak for him, but I believe he has a bit of a comeback plan with YouTube as well, by the sounds of it. Hi Tom, should we consider Australian dollars to New Zealand dollars in terms of making discounted cash flow models, or even American currency to NZD? Yeah, interesting question. I guess when I do a discounted cash flow, I pretty much just use a single currency, usually the currency that sits in the financial statements of that particular company. So if it's a US company, it'll be in US dollars. If it's an Australian company, it'll be Australian dollars, and so on. So, you know, foreign exchange over time will have an influence on your returns, and we're seeing that a lot with some pretty wild currency movements at the moment, actually. But I don't try and like do a New Zealand dollar discounted cash flow for a US company or anything kind of crazy like that. So I tend to just keep it simple, stick to whatever the company's financial statements are denominated in, and if I think it looks interesting in those currencies, I will take my New Zealand dollars, which is what I earn money in, transfer it to that currency and make the purchase. That's essentially the way I think about it. Okay, moving now to some of the top rated questions. I see we've got a couple around Seritage growth properties. So the first one is from Anton. Hi Tom, do you think increasing interest rates changes the Seritage investment thesis since higher rates can lower property prices? Is the liquidation value of $18 to $28 fair, even if interest rates would continue to go up in the 2 coming years? Would love to hear your opinion. And another one while we're at it from Retro Ranger on Seritage as well. If SRG drops to 6 or 5 again, would you increase your stake, even if the estimated distributed range of the liquidation is less than $18? That would be a huge return from that. Yeah, I guess there's been a couple of updates on Seritage recently, or one in particular. I will leave a recent SEC filing link down in the description below, because management have actually come out and given a little bit more clarity on that. I believe it was $18.50 to $29 per share distribution range that they were talking about from a liquidation, and they did actually come out and say that the top end of that range at least is probably unlikely, and one of the explanations they gave for that is a change in market conditions, which is exactly what Anton's talking about here. Generally speaking, increasing interest rates will also increase the cap rates on properties. So people that might have wanted a 6% return before, or that might have accepted a 6% return before, just for argument's sake, might now be looking for a 6.5% or 7% or even 8% return. And if the rental, income that a property is generating hasn't changed, that means the price must come down. So to answer your question, Anton, yes, I think it's a risk. I think it's potentially the biggest risk is just, dramatic changes in the real estate market in the US. And to answer your question, Retro Ranger, you've done the maths there. If it drops to 5 or 6 and they distribute 18, that's still pretty interesting, but do your own work on it. And the other thing I would say is that there is leverage built into the SRG situation. So, if we see a 20% drop in real estate prices, for example, that will be more than a 20% drop in the equity value of Seritage or in the liquidation value of Seritage. So I would go through the exercise of doing some of the maths on that front as well. Next question here is from Martin Osterman. Hi Tom, when doing a DCF valuation, how do you factor in share dilution and share buybacks? Yeah, good question. I must say that that's really not something I've ever actually done before. My reasoning for that basically is, I'm not trying to buy a dollar for 95 cents or anything. I'm trying to buy at significant discounts to intrinsic value. So I don't know that I've ever looked at a company where the buybacks are so material or where the share dilution is so material that it significantly changes that equation. Although I'm sure that's something that'll happen to me in future. One method that you may want to look at would be something like a simple Davis double approach. I know Frank Tabor's spoken about this a little bit on Twitter before, and that's not a DCF valuation, but it is like a Shelby Davis, who's a investor with a very good track record. It's a simple kind of, in your head type calculation about where your returns might come from as an investor. So you might say that I'm going to get, 10% a year from earnings growth, I'm going to get 2% a year from dividends, and I'm going to get 2% a year, over an extended period from multiple expansion, for example. And if the company is also, say, retiring 2 or 3% of their shares each year, you could factor that into the equation as well. So I try not to overcomplicate it. Again, we're looking for big margins of safety here, but something like a Davis double approach might be an interesting kind of mental model to add to your mental toolkit, I guess. I've got one here from Greg. How can you be certain Thor can continue to grow sales given increasing cost of living, inflation, rising interest rates, etc.? People have less money and the finance on an RV will be higher than previous years. And I think we actually also had a second question on Thor, which was from Tim. Hey Tom, I know you're a big fan of Thor. I have done a deepish dive and I'm struggling to see how they are going to meet their EPS target of $27. So Tim's referring to some targets released in Investor Day in June, I think, from Thor Industries, where they said they want to reach $27 in earnings per share by 2027, I think it was. So Tim goes on to say, to me, it looks like they are going into a down cycle and the economy isn't on their side. My thesis is there will be increased demand and supply for second-hand RVs due to the boom in sales over COVID, and economic pressures will hurt sales over the next few years. Do you have any thoughts on how achievable this target is? So these are really good questions related to Thor Industries. The first thing I should say is probably about the same time as this video is going out. I think Thor's actually reporting earnings, so it'll be interesting to kind of see what they report there. And I think in their Investor Day, they suggested that they're also going to issue some guidance, which is something that I don't believe Thor has ever done. So it'll be interesting to hear right from the horse's mouth, I guess, where they think things are heading maybe in the shorter to more medium term. So yeah, I guess in terms of meeting their $27 earnings per share target, I believe the target built in there is to reach about $20 billion in revenue. They recently did, in the past 12 months, they've done about $16 billion. So they're looking to grow their revenue by about a third or a little under a third over the next 5 years. And if we look at the track record of Thor, that is certainly not unachievable. I should say that a lot of their previous growth has been from acquisitions, but they've also had significant organic growth over time as well. I think it's brand KZ. I'll put the exact slide up here, but a lot of their brands have had pretty significant organic growth since Thor acquired them as well. KZ, I think it's something like 150% since 2014. So I would expect some organic kind of growth, maybe a little bit from acquisition. The thing that is really going to drive that earnings per share target to me is actually how serious they can get with their share buyback program. They've already got plans to buy back about 14% of their shares outstanding over the next 5 years, I think it is, and that share repurchase program implies share prices a lot higher than where the current share price is. So, if the share price stays down or if they increase their buyback program, that's going to be really helpful to getting towards that $27 target. The trailing 12 months earnings per share for Thor is pushing $20, and again, after tonight's earnings, that number may go slightly up or slightly down. So going from 20, which admittedly has been a boom year for Thor, to 27, I don't think is out of the question, particularly given management's track record and so on. And in terms of just the general economic cycle, Thor is definitely about to go into some challenging times. Greg brings up some good points here about increased cost of living, inflation, rising interest rates. People often finance these RV purchases, so that's definitely going to be a headwind. Thor is a cyclical business. It has always been cyclical. It will always continue to be cyclical. If we go back to the most extreme situation I think Thor's ever had was during the financial crisis. Again, I'll put the numbers on the screen here, but revenue went down something around 40%, and Thor remained profitable. They've been profitable for more than 40 years straight at this point. Each downturn they've had has been more profitable than the previous downturn. And they recently shared some information where they think if they have something like a 35% decrease in revenue, they're pretty sure they can still earn $6 or $7 a share, and they're trading at like $70 a share as a recording. So to be at 10 times kind of trough earnings, you can make up your own mind on what you think the risk reward profile looks like there. Personally, although there might be some short-term headwinds, I think it's exactly the type of thing long-term investors can have an advantage playing in those types of areas, particularly when the upside scenario is only like they're trading at like 2.5 times that 2027 earnings target at the moment. And again, if the stock stays down, it kind of counterintuitively works in their favor because they can do more buybacks and so on. But yeah, a couple of good questions there on Thor, so thank you for those ones. Next one is from Saeed Fahan. Hi Tom, you seem to be a true fan of Li Lu. Certainly am. I think if I get out of the way a little bit, you may be able to see some Li Lu photos on my wall, or a photo with Li Lu on my wall. Not sure if you caught that at all, but yes, definitely. And Saeed asks, can you please suggest any resources, either videos or anything as such, to understand Li Lu in much more detail? Sure. The first place I would point you is just the Himalaya Capital website, which is Li Lu's fund. There's a few different resources of interviews and books and previous articles and letters and things that Li Lu has written, so definitely check those out. I know Li Lu has a couple of different talks on YouTube, one from the early 2000s with Columbia Business School, and I think a couple other talks he's given over the years as well, although he's a pretty private individual, so there's not a whole lot out there, but those are hopefully a couple of good starting points. Okay, next question here is from Zach. What's your take on debt levels? Do you fully penalize a levered company by subtracting net debt from your estimated fair value market cap, or does that depend? And if so, in what instances would you not fully penalize a company for this? Yeah, to keep it very simple, I do tend to subtract all of the net debt from my company's market cap, or in other words, I just use the enterprise value, although there are some situations where I would adjust that enterprise value. So a good example would be like long-term leases. I think it's a weird quirk of accounting that gets included as a long-term liability that's factored into the enterprise value. It is a genuine long-term liability. The company will have to pay those long-term leases over time, but it's not like they've borrowed that capital and shoved it into the business to make it grow or anything. So there are some adjustments I do with that type of stuff, but you're talking specifically about just debt here, and I definitely do kind of subtract the full amount there. Now, in terms of cash and marketable securities and stuff on the other side of the equation, sometimes I actually do discount that a little bit. If a company goes into a liquidation or something, that debt is worth 100 cents on the dollar in terms of what you will owe to those debt holders. But the cash isn't necessarily always available to shareholders. Like the very cheap Japanese nets have always been a good example of this, where there's cash, boatloads of cash sometimes sitting in these companies that just never gets out because management kind of hoards it for a rainy day and that sort of thing. And it's a bit of an illusion, really, that the company might actually be cheap if the cash never comes out. It's kind of like this frozen corporation example that Ben Graham used to talk about, where if a company earns all this money in its lifetime but it never actually pays anything out, then is it really worth anything? So yeah, there's a few thoughts on kind of debt and cash and how I think about it on the balance sheet. Okay, let's take one last question here. This one's from Dylan Thomas. If you were only allowed to follow one super investor, who would it be and why? It's a very good question. I think if I could only follow like one super investor a quarter or a year or something, but I could switch back and forth, I would probably pick Warren Buffett, just because I think it's the most, or Berkshire Hathaway, I guess. that kind of gets me a few super investors in a single 13F, so that might be cheating a little bit here, but I find that one the most interesting to kind of see what he's up to, even though Berkshire tends to operate in very large companies, and I can operate in smaller companies if I want to. That is one that I would really like to keep an eye on. If I had to choose one for life, thinking about Buffett's age a little bit with that one, it would probably be like a Li Lu, I think would be number one. It would be nice to be able to see what he was doing outside of the US, because I suspect there's a fair bit going on outside the US that we can't see, but I think he would be one super investor I would follow. anything I've basically ever heard Lulu say has always made kind of rational sense to me, and he's got a very good track record, as I understand it, to kind of back that up as well. So that's who I would choose to follow for the very long term, and that's why. So those are all the questions that we have time for in this video. Thank you very much to everyone who did ask a question. Like I say, if you want to ask a question in a future Q&A video, just keep an eye out for the community post, in a little less than a month's time now, asking for your questions, and be sure to turn your notifications on for the channel so that you can catch those as soon as I put them out there, and you can get a question in quickly and hopefully get it on a video. So I do appreciate everyone watching right through to this point. If you did enjoy the video, be sure to like and also subscribe to the channel if you are new here. But that's it from me for this one, and I'll see you in the next video. Cheers.